We've all heard the same financial advice. Save money, avoid risk, get a stable job, and stick to the traditional path. But what if this advice is actually holding you back? In today's fast-changing world, the rules of money have evolved, yet many people are still following outdated strategies that no longer work. While it feels safe, it can quietly limit your growth and keep you stuck financially. Today, we will talk about why following traditional money advice is actually keeping you poorer than ever. So before we get started, make sure to hit that like button. Also subscribe to my channel. 10. Just save your money. Saving money is important, but saving alone won't make you wealthy anymore. Traditional advice tells you to put money in a savings account and let it grow safely. But here's the problem. Inflation is quietly reducing the value of your money every single year. Example, if your savings account gives you 2% interest, but inflation is 7%, you're actually losing money in real terms. Your bank balance might grow, but your purchasing power shrinks. Saving without investing is like trying to fill a bucket with a hole in the bottom. 9. Get a stable job and stay there. For decades, job stability was the key to financial security. But today, stability doesn't guarantee growth. Companies restructure, automate roles, outsource work, and freeze wages. Staying in the same job for years without increasing your income can quietly limit your financial future. Example, someone who stays in the same job for 10 years with small raises may earn far less than someone who switches roles every few years and negotiates better pay. 8. Avoid all debt at all costs. Debt has a bad reputation, and for good reason. High-interest debt can destroy finances, but not all debt is bad. Traditional advice often treats all debt the same, but in reality there's a difference between bad debt and strategic debt. Example, bad debt. Credit cards used for unnecessary spending. Strategic debt. Loans used to build assets like a business or real estate. Avoiding all debt can mean missing opportunities to grow wealth faster. 7. Cut expenses as much as possible. Cutting expenses is helpful, but it has limits. You can only reduce spending so much before it affects your quality of life. Traditional advice focuses heavily on saving small amounts instead of increasing income. Example, you can skip coffee and save $100 a month, but increasing your income by $1,000 a month has a much bigger impact. Over-focusing on cutting costs can trap you in a scarcity mindset where you're always trying to survive instead of grow. 6. Work hard and you'll get rich. Hard work is important, but hard work alone doesn't guarantee wealth. Millions of people work extremely hard in physically demanding or low-paying jobs, yet struggle financially. Meanwhile, others build wealth through leverage, investments, or scalable systems. Example, working 10 extra hours a week increases income slightly. Investing or building a scalable business can increase income without trading more time. 5. Go to school, get a degree, and you'll succeed. Education is valuable, but traditional advice assumes that a degree automatically leads to financial success. In reality, many graduates face student debt, limited job opportunities, and salaries that don't justify the cost of education. Example, someone may spend years earning a degree and graduate with debt, only to enter a job market with low starting salaries. What you should do instead? Focus on skills that are in demand, not just degrees. Practical skills like technology, communication, or business often provide better financial returns than traditional education alone. 4. Play it safe. Traditional advice encourages safety. Avoid risks, stick to what you know, and don't take chances. But in today's world, playing it too safe can actually be risky. Example, keeping all your money in cash might feel safe, but inflation erodes its value. Avoiding investments means missing out on growth opportunities. What you should do instead, take calculated risks, learn, research, and make informed decisions. But don't avoid opportunities just because they feel uncertain. 3. Buy a house as soon as possible. Owning a home is often seen as a key milestone, but it's not always the best financial decision for everyone. Traditional advice assumes real estate always goes up and owning is always better than renting, but the reality is more complex. Example, buying a house with high interest, maintenance costs, taxes, and limited flexibility can sometimes be more expensive than renting and investing the difference. What you should do instead, evaluate your financial situation, location, and long-term goals before buying. A home can be a good investment, but only if it fits your strategy. 2. Save first, invest later. Many people delay investing because they think they need a large amount of savings first. Traditional advice often encourages building a big savings cushion before taking any risks. But waiting too long means losing valuable time for compounding growth. Example, investing $100 a month starting today can grow significantly over decades. Waiting 5 or 10 years reduces the power of compounding dramatically. 1. Follow the same path as everyone else. The biggest flaw in traditional money advice is that it assumes one path works for everyone. Go to school, get a job, save money, retire. That path may have worked decades ago. But today, it often leads to slow financial progress and limited opportunities. The world has changed. Technology, globalization, and new industries have created entirely new ways to earn, invest, and build wealth. Example, people today can build online businesses, invest globally, create digital products, or earn income through multiple streams, opportunities that didn't exist in the past. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.